The warning signs are everywhere. A major bank collapse could be closer than we think, and the Fed's plan may not be enough to stop it. Oh, and it's getting worse. Recession risks are skyrocketing, and Japan just threw another wrench into the mix with the second round of the Japanese carry trade collapse. Today, we'll break down exactly what's happening and why it's shaking the foundations of global markets. Think this sounds like the same old story? Well, it's not. We're talking about a situation where big banks are now sounding the alarms, with Goldman Sachs and JP Morgan both raising their recession forecasts, and Japan's central bank is scrambling to bail out markets. This is not just about Japan or the US. The ripple effects could be massive. In this video, we'll connect the dots. How does Japan's move affect your investments? What is the Fed's next move? And could their collapse plan make things even worse? Stick around, because by the end of this video, you'll know exactly what's at stake and why the next few months could be make or break for the entire global economy. And trust me, by the end of this, you'll understand why it's not just Japan or a few big banks that are on edge. This could impact all of us in ways we haven't seen before. Let's start with Japan, because their recent moves have sent shockwaves through the entire global financial system. The Bank of Japan just stepped in with what can only be described as an emergency intervention, and trust me, that's not a good sign. What we're seeing right now is the second round of the Japanese carry trade collapse, and it's about to get messy. Now, if you're not familiar with the carry trade, here's a quick breakdown. It's a strategy where investors borrow money from countries with extremely low interest rates, like Japan, and then invest that borrowed money into assets from countries with higher returns. It's been a moneymaker for years, fueling massive investments and global liquidity. But here's the catch. The whole thing unravels when interest rates in those low-rate countries start to rise, or when inflation gets out of hand. And guess what? That's exactly what's happening right now. Japan's central bank, the Bank of Japan, has been struggling to keep control of their economy. They've tried holding on to those rock-bottom rates, but with inflation creeping higher and higher, it's slipping out of their hands. So what do? They step in with a massive bailout to try to stabilize the markets. Sounds like a solution, right? Well, not quite. The more they try to intervene, the worse it gets, because this isn't just about their own economy anymore. It's about a global system that's built on borrowed time and borrowed money. And here's where things get really interesting. When Japan made their move, markets around the world reacted. At first, we saw a little relief, like maybe this could stabilize things. But then, as the dust settled, fear kicked in. Despite Japan's intervention, their markets started tanking, and now the effects are spreading fast. Remember, Japan is the world's third largest economy. If they can't stabilize themselves, the ripple effect will be massive, and it's already hitting us here in the US. US stocks aren't immune to what's happening in Japan. In fact, we're already seeing the repercussions. Goldman Sachs, one of the biggest names on Wall Street, just raised their recession risk to 25%. Now that might not sound like a lot, but when you're talking about major financial institutions that hold trillions of dollars in assets, it's a significant red flag. And then we've got JP Morgan, who went even further, boosting their odds to 35%. These aren't just random guesses. They're based on real concerns about how deep this collapse could go. Here's why this matters. The fear is real. Big banks are starting to freak out, and not just because of what's happening in Japan. This is all happening at the same time the Federal Reserve is tightening its grip on the economy, and that combo is a dangerous one. Think about it. Japan's trying to prop up their markets, but the Fed is taking the opposite approach. They're slowing down the economy with higher interest rates to fight inflation. What does that mean for us? Well, if you've got major banks like Goldman Sachs and JP Morgan raising the alarm, and the Fed still tightening, we're in for a bumpy ride. This could trigger a global economic slowdown that hits everything from stock markets to real estate, and it might be happening sooner than we think. Now, let's talk about what's happening closer to home. Because while Japan's collapse is making waves, the Fed's actions might just push us over the edge. Here's what I think. The Federal Reserve is walking a tight rope, and any misstep could accelerate the collapse we're trying to avoid. The Fed has been aggressively raising interest rates to cool down inflation, but as they do that, they're tightening the screws on the entire economy. Think about it this way. Every time the Fed raises rates, borrowing costs go up. That means higher interest rates on mortgages, car loans, business loans, everything. The goal is to slow down spending, but here's the catch. The longer they keep those rates high, the more pressure they put on the entire financial system. And the banks, they're starting to feel it. They're starting to feel it. Here's where things take a step further. Major institutions like JP Morgan, Goldman Sachs, and even MUFG are all sounding the alarm. JP Morgan just raised their recession risk for 2024 to 35%, and they're not alone in thinking that the Fed's actions could be making things worse. Goldman Sachs has been issuing similar warnings, and MUFG, one of the largest financial institutions in the world, has flat out said they're not convinced that things will stabilize anytime soon. They've rejected the idea of a soft landing and are betting on a bumpy landing instead. What does that mean? Simply put, they believe that the Fed's tightening will trigger more damage than we expect, leading to an even harder economic hit. But it's not just about the banks freaking out. We're seeing it on the consumer side too. Take a look at credit card debt. It's skyrocketing. Companies like Discover and Capital One, which cater to lower-income consumers, are seeing their charge-off ratios surge. That means people are defaulting on their credit card payments at an alarming rate. Why? Because those higher interest rates make it harder for everyday consumers to keep up with their bills. It's a domino effect. When consumers can't pay off their debt, the banks suffer, and the entire system gets even more fragile. And then there's the employment situation. The Wall Street Journal recently reported that pay rates for new hires are down 7% across the board compared to last year. In finance, that drop is even steeper, down nearly 10%. What's happening here is clear. Companies are tightening their belts, cutting costs, and offering lower wages to new employees, all while reducing the number of jobs they're offering. And this is just the beginning. As the Fed keeps tightening, we're likely to see more layoffs, fewer job openings, and ultimately a hit to consumer spending. Because if people aren't working, they aren't spending. So, what does all of this mean for the average person? We're heading into a perfect storm. The combination of Japan's carry trade collapse, the Fed's aggressive rate hikes, and rising consumer debt is setting the stage for a major economic downturn. Banks are already starting to brace for impact, and the ripple effects will soon hit everything from housing markets to stock portfolios. But here's where things get really alarming. If the Fed doesn't adjust course soon, the collapse could hit harder and faster than anyone's predicting. Now, let's talk about what this means moving forward and why you need to pay attention, because this could get worse before it gets better. The Fed is in a tough spot. If they keep rates high to fight inflation, the economy slows down even more, pushing us closer to recession. But if they lower rates too quickly, they risk reigniting inflation, which could cause even bigger problems. Here's where the real danger lies. The longer the Fed waits to make significant changes, the tighter financial conditions get. And remember, while they're sitting tight, inflation is still cooling down. This means those high interest rates are biting harder and harder, especially for smaller businesses and consumers. The Fed's plan might be to let the economy gradually slow down, but they may have underestimated how fragile things already are. Look at MUFG's analysis. They've warned that this bumpy landing could quickly turn into a full-blown economic crash if the Fed doesn't act. Their prediction is that as the Fed drags out their easing cycle, the risks grow higher and higher. And they're not the only ones seeing it. Banks across the board are starting to hedge their bets, preparing for what could be a much harder hit than expected. So, what can you do? At this point, understanding the risks is critical. We're already seeing credit markets tighten, and companies are starting to report weaker earnings. Consumer debt is climbing, and layoffs could be right around the corner. If you've been thinking about your investments, this is the time to reassess. Some experts suggest increasing your cash allocation, like Warren Buffett has been doing. Holding on to cash gives you flexibility when markets take a turn. And then there's the stock market. It's already reacting to the chaos. Japan's crisis and the Fed's tightening have combined to create a market that's more volatile than ever. If you're looking to make any moves, timing is key, and it's important to stay informed. So where does that leave us? Japan's carry trade collapse is already sending shockwaves through the global financial system. Meanwhile, the Fed's slow approach to easing might be tightening the noose on our economy more than we realize. Big banks like JP Morgan and Goldman Sachs are starting to freak out, and they're not doing it without reason. In the next few months, we're going to see how this plays out, whether the Fed can pull off a soft landing or if we're heading straight into a deeper recession. The warning signs are all there, and it's up to us to stay prepared. Keep an eye on consumer debt, watch for more bank reactions, and most importantly, be ready for whatever comes next. If you found this breakdown helpful, don't forget to hit that like button and subscribe for more updates. I'll be keeping you posted as we see how this all unfolds. Thanks for watching, and until next time, stay informed, stay ready, and be cautious with those investments. Remember, this is not financial advice.